Options trading can initially seem complex and perhaps even a little intimidating, but at its core it offers a world of flexibility that extends far beyond simply buying or selling shares. It's about having choices and control. An option is essentially a contract, a legally binding agreement, giving the buyer the right, but crucially not the obligation, to buy or sell a specific asset like a stock at a predetermined price by a certain expiration date in the future. Think of it as securing a price for that asset right now, with the choice to act on that secured price later, specifically if the market moves in a direction that favors your position. This fundamental characteristic opens up a vast landscape of strategic possibilities for both seasoned traders and strategic investors alike. These strategies allow you to precisely define your risk exposure, potentially profit from a wide range of market conditions, and even generate income streams, hedge against potential losses in your portfolio, or speculate on future price movements with a calculated and informed approach. Each strategy comes with its own unique risk profile, potential reward, and is best suited for a specific market outlook or expectation. One particularly advanced and powerful approach is the call ratio backspread, a sophisticated strategy best suited for those with a solid and well-rounded foundation in options trading principles. Unlike some other strategies that focus on collecting small premiums over time, the backspread strategically positions you to potentially capture significant capital gains. It's undeniably a bold play, fundamentally built on the expectation of a strong and sustained upward move in the underlying stock's price. In this comprehensive explainer, we'll break down the call ratio backspread step by meticulous step. We'll thoroughly explore exactly what it is, delve into the strategic reasoning behind why traders choose to implement it, and pinpoint the specific market conditions under which this strategy truly thrives and delivers optimal results. Our primary goal is to demystify this powerful and often misunderstood strategy, making it accessible for finance professionals who are ready to move beyond the basics and expand their trading toolkit. The call ratio backspread. It's a strategy that might sound complex, but it's built on a relatively straightforward idea. Is a bullish options strategy designed for those who believe a stock is poised for significant growth, designed to profit from a significant rise in a stock's price. It's not about small gains, it's about capturing substantial upside. It's constructed by selling a certain number of call options at a lower strike, a move that generates income up front, and buying more calls at a higher strike, positioning you to benefit from a major price increase, commonly a 1-to-2 ratio. This means for every call option you sell, you buy 2. Selling the lower strike call collects a premium, providing an immediate cash inflow, helping offset the cost of the higher strike calls. This reduces the overall expense of establishing the position. Ideally, the trade can be set up for a net credit, further enhancing the appeal of this strategy, meaning you're paid to open the position. This initial credit acts as a buffer, reducing your risk. The real goal isn't the small credit, although it's a nice bonus to have, but to profit from a substantial price surge. The bigger the move, the greater the potential reward. Because you buy more calls than you sell, you have a net long position, giving you unlimited profit potential. Your profit accelerates as the stock soars past the higher strike. The gains can be significant and rapid. This is not just for a mild upward drift. It requires more than just a little movement. It's for a decisive breakout. A true surge in price is what this strategy thrives on. The structure means it performs poorly if the stock rises only a little or even trades sideways. It needs a powerful move, a strong and sustained upward trajectory, to overcome the short call's drag. The sold call option limits your gains up to a certain point. So this strategy is for traders with conviction, those who aren't afraid to make bold predictions, a strong belief in a major upward price surge. It's about having the confidence to back your analysis. It's a refined, high-upside way to express bullishness, a sophisticated tool for the optimistic trader. Leverage is central to the call ratio backspread. By buying more calls than you sell, you control more shares with less capital, amplifying potential returns. A small move in the stock can translate into a much larger percentage gain on your risked capital. The further the stock moves above the higher strike, the more profitable the position becomes. Volatility is the other key factor. Higher volatility means options are more expensive, but the backspread benefits from rising implied volatility after the trade is placed. Since you're net long options, a volatility spike increases your position's value. The ideal time to use this strategy is when you expect both a price surge and a jump in volatility, often around earnings or major announcements. Entering when volatility is low and seeing it expand, along with the stock price, creates a powerful profit engine. The combination of leverage and volatility is what makes the backspread so compelling. The call ratio backspread's appeal lies in its risk profile. Maximum loss is strictly defined at entry, occurring if the stock lands at the long call's strike at expiration. The loss is the difference between strikes adjusted for any net credit or debit. Before you trade, you know your worst-case scenario to the penny. In contrast, the potential reward is unlimited. As the stock rises, your profit keeps growing. The short call's drag is quickly overwhelmed by the gains from your long calls. However, there's a valley of death. A moderate price rise can still lead to maximum loss. The strategy only becomes profitable after a significant move upward. It's not for the timid, it requires conviction in a big price move. Let's make this real with Apple Inc. Suppose it's July 18th, 2025, and Apple trades at $200. A trader expects a strong earnings report to send the stock surging. They choose a call ratio backspread to capitalize on this, expecting both a price breakout and rising volatility. The trader selects options expiring in 45 days, selling one $205 call and buying two $210 calls. The $205 call is just out of the money. The $210 calls are further out and cheaper. The premium from the $205 call helps finance the $210 calls. Now, let's see how the numbers work. Let's delve deeper into the mechanics. Continuing with Apple at $200 as our example, the trader strategically sells one $205 call, collecting $500 in premium. This is the initial credit received for opening the position. Simultaneously, the trader buys two $210 calls, paying $250 each, totaling $500. This offsets the initial credit, creating a unique risk profile. The trade is opened for zero net cost, an even money spread. This means no upfront investment is required, making it an attractive strategy for some. Maximum loss occurs if Apple closes precisely at $210 at expiration. This is a critical point to understand for risk management. In this scenario, the $205 call is $500 in the money, meaning it has intrinsic value. However, the $210 calls expire worthless, as they are at the money. They hold no value at expiration. Therefore, the max loss is $500, representing the difference between the sold call and the expired calls. If the trade had a net credit, meaning more premium was received than paid, that would reduce the potential loss. The break-even point is calculated as the higher strike price plus the max loss per share. This is where the trade transitions from loss to profit. In our example, $210 plus $5 equals $215. This is the price Apple needs to exceed for the trade to become profitable. Above $215, the trade enters the profit zone and becomes increasingly profitable as the price rises. For every dollar above $215, the trader gains $100, reflecting the leveraged nature of options trading. This is because they're net long one call, meaning they benefit from further upward movement. This clarity, knowing the maximum risk, the break-even point and the potential upside, is crucial for informed decision-making. It transforms speculation into a well-defined strategy, allowing for a more controlled approach to trading. The trader can then execute the trade with confidence, knowing the parameters of the position. They are fully aware of exactly what's at stake, mitigating emotional decision-making. The order should always be placed as a single spread, ensuring proper execution. This ensures all parts of the spread fill simultaneously, avoiding unintended consequences. This structured approach is what distinguishes the backspread as a calculated strategy rather than a reckless gamble. Now, with a solid understanding of the mechanics, let's explore what happens if the market moves as expected and how the backspread performs. The trade is live. Apple smashes earnings and the stock rockets past $205, $210, and then $215. At $225, the short $205 call is a $2,000 loss, but the two long $210 calls are $3,000 in the money, a $1,000 net profit. That's a 200% return on the $500 risked. If volatility also jumps, the position gains even more, as the long call's value inflates faster than the short call's liability. The profit keeps growing as the stock rises. At $235, the net profit would be $2,000. The backspread's beauty is unlimited upside with defined risk. The trader's conviction and strategy have paid off. The next step, deciding when to exit and lock in gains. Managing the exit is as important as the entry. Let's look at how to do that. Exiting the trade is crucial. After a big move, the trader can close the position by reversing the original trade, buying back the short call and selling the long calls as a spread. Many set a profit target, say a 150% or 200% return and exit once it's hit, avoiding the risk of a reversal. If the stock falls, all calls expire worthless. If the trade was opened for zero or a credit, the loss is minimal or even a small gain. The toughest scenario is if the stock lands at the point of maximum loss. As expiration nears and the stock hovers near the long strike, the trader must decide whether to hold or cut losses. Often, closing early limits the loss and preserves capital. Discipline in both entry and exit is key to long-term success. The backspread structure helps manage risk, but execution matters. Always have a plan for both profit and loss. The call ratio backspread is a sophisticated, high-upside options strategy for traders with strong, bullish conviction. It offers defined risk, unlimited profit potential, and benefits from both leverage and rising volatility. It's best used when you expect a major price move, like around earnings or big news. The trade-off, a moderate rise can mean maximum loss, so conviction is essential. Careful selection of strikes, expiration, and disciplined exits are critical. Calculating risk and break even before entry is a must. For finance professionals, the backspread is a powerful tool to express a bold market view with controlled risk. Master its mechanics, and you add a potent strategy to your trading arsenal. Thanks for watching. Good luck with your trading and see you next time.